interest rates are still historically low. And with this product, it is a 1 month adjustable. So if somebody can get into a low, 3.5%, 3.75% fully amortized 30-year fixed interest rate right now, why would it be more beneficial for them to go into the all-in-one, which is a little bit of a riskier product since it is a 1 month adjustable. And with rates on the rise, I mean, they could go up pretty high. So what would your, advice be to somebody posing that question?
Well, first, that ultimately, I think that every customer that is looking at this and really kind of kicking the tires has to ask themselves, what is a matter of more importance, the interest rate that comes with their loan or the amount of interest they pay on their loan, right? If we can establish that first, the answer to that first, and I think that your audience would agree that the real money you have to earn and spend on a debt, right, is more important than just literally the interest rate. So once we establish that, then I think the next thing to consider and ask is it possible to have an interest rate that's slightly higher? And by the way, the interest rate on the all-in-one loan is very competitive. It's not high. It tends to move with monetary policy set in the United States by our Fed. And that really, is aligned with, market 30-year fixed interest rates, so even though it can adjust, it not only can adjust upward here and there, but it also can adjust downward. It just goes through those cycles over time. The biggest benefit of the all-in-one loan is the application of the money you already have in your possession. Most people will earn more money in just 5 years than they owe on their mortgage. And most of those dollars, if not all of those dollars, flow through their checking account, right? And you pay your bills from there. And if you build up some residual money in a checking account, a lot of customers keep it there and some move it to a savings account. Either way, these short-term deposit accounts see a lot of money, a high volume of money over time, but they pay us very little in return, right, for that loyalty. The biggest benefit of a checking account is just the secured access to our money. Well, what if that same secured access to money is available within your mortgage, but while you're not using your money, your mortgage principal balance is lower by the same amount of money you deposited? And what if that mortgage recomputed interest daily, right? Recomputed interest daily on that lower balance, right? Because your cash or idle money is sitting in there waiting to be spent on something else tomorrow, next week, next quarter, next year. Saving you monthly and annual and total interest costs. That's how this loan works. So, to answer your question, Danielle, the biggest cause of interest expense is not the interest rate. It's actually the length of time you're in debt and how high or how low your principal balance is, where it's headed. Is it remaining high for a very long time, or is it headed down quickly? If it heads down quickly, you're going to pay less interest. Let me give you a quick example, a mathematical example. And this sounds extreme, I know, but let's just use a really high interest rate against a really low interest rate, okay, and compare the terms. If we were interested in saving time and money, and I had two choices, a 10% mortgage that paid me off in 5 years, or a 2.5% mortgage designed to pay me off in 30, that 10% mortgage is a significantly better deal. They'll save a ton of time and a ton of money, right? And when you save time and money, that creates opportunities. Opportunities to go buy another property, opportunities to pay for my kids' college education, fund, financial challenges as they arise here and there. There's a variety of things and maneuverability that you achieve because you avoid so much interest cost. And, reducing your rate isn't the exclusive way to do that. A more impactful way to do that is to attack your principal. And that's what makes this so special. It makes it easy.
Yeah. And actually, it just kind of I just realized when you said zero balance checking account in the beginning, I was trying to kind of figure out in my mind what that means. And I think in simple terms, when we're talking about a checking account combined with the all-in-one loan, what's essentially happening is any time you deposit money into that checking account, and you can correct me if I'm wrong, but the money goes into the checking account, whether it's idle money that was sitting in another checking account and it's just sitting there, so why not put it into this account? Direct deposits coming in, maybe you flipped a property, you're putting money into this checking account. At the end of the day, that checking account sweeps, right? And it takes that money and it puts it down on the principal balance of the loan.
That's exactly right. Yep.
So
So
then,
if I owe $300,000 on my all-in-one loan right now, that balance is held by the HELOC, and I deposit, call it $5,000 today in my all-in-one loan checking account. They're linked together. They engage each other automatically. I don't have to lift a finger. There's no extra manual step to do anything. Today, that $5,000 deposit will automatically sweep. It's called a sweep. It's just a digital transfer where it sweeps the money from the checking account, and the checking account at midnight will show a zero balance. That's because that $5,000 deposit that I made earlier that day sweeps over to the HELOC and paying down the balance. It pays down the balance by $5,000. So I literally wake up the next morning, and instead of owing $300,000 on my home, I only owe $295,000 on my home. And it recomputed interest at midnight, right? The previous night. So if I spend $200 today on grocery shopping, my balance goes up by $200. But the bulk of my money sits idle, waiting to be spent. And I think this really kind of, brings us into highlighting, kind of the obvious, but I think it's so obvious we don't think about it on a daily basis as just consumers in general. Think about how we spend, or rather think about how we don't spend. Our bills and expenses aren't paid for on one single day each month, right? We don't go grocery shopping for the entire month on just one day. We do that weekly. Well, our utility bill isn't a weekly expense. It's a one-time monthly expense. Same thing with a cell phone bill. Your property taxes aren't necessarily due until, so maybe semi-annually. So we earn a lot of money along the way, and it sits idle waiting to be deployed for those expenses. And like most Americans, a lot of people have residual cash sitting in a checking account, because not many people, believe it or not many people live actually paycheck to paycheck and zero out their checking account balance every month. Most people that can qualify for a mortgage have residual money always sitting in their checking account or savings account. So all that money is put to work in the all-in-one loan.
right. Yeah, no, that's, so then when you're going to make payments, let's say you're going grocery shopping, you're going to have a credit card, right? That's linked with the checking account. Yeah. You don't have to do anything to move money from your mortgage to the checking account then go grocery shopping. It's all combined together.
It's all automatic, no manual step. The all-in-one loan checking account features include everything that you would normally receive with a traditional checking account that's not a zero balance account tied to a mortgage. So ATM debit, Visa cards, check writing, online banking, mobile banking, bill pay. You could link external accounts to it, ACH, transfer money in between accounts, wire money internationally or domestically. Any transactional fees that are incurred are reimbursed, from third-party network providers. So if you go to an ATM machine, maybe at a 7-Eleven as an example, and that network provider for that ATM machine charges $5 to pull out 20, that $5 charge is actually reimbursed automatically back to the account. So it's a consumer-friendly, checking account that just happens to push your money to the mortgage side, allowing your money to work harder for you until you need it. So in effect, Danielle, it's kind of like you're literally investing your money into your home, right? Even if you need to spend it tomorrow or next week, today you're able to invest your money into your home, which protects it. It also shields your cash, right? It protects it because you're deploying it into an asset, which is your real estate, which is appreciating at the present moment. And while it's there, it's also serving to reduce your mortgage expense, your mortgage interest expense at the rate of the loan itself. So would you rather save, as an example, 3.75% in interest, or earn, 0% in your regular checking account? Right. It's sort of a no-brainer.
Exactly.